Welcome back to the Dividend Diplomats YouTube channel. You got Lanny, Bert. You know us by now. We are the freaking Dividend Diplomats. Everybody, last week Lanny published his January watch list. This week I'm going to publish my January watch list. So get ready. We got 3 stocks that I will be watching here in January 2023.
Guys, before we do, you're at the channel, do us a favor. Let's spread the love on dividend investing. Smash the heck out of that subscribe button. Give the video a thumbs up. We're trying to get to 20,000 subscribers by March. So we've got less than 90 days to go, and we need a little over 4,000 subscribers left. Bring it. Let's get some fire going here on the channel.
That's right. So today we're going to talk to you about these 3 undervalued stocks. I own 2 of the companies that we are going to talk about. And one of them is a stock we featured recently on our channel, but we haven't bought it yet. And it's still not sitting in my portfolio at the time we're recording this. So get ready, everybody, because 2023 is on a fantastic start to the year. It's been fun so far to be an investor.
Guys, we're in the middle of the second week of 2023. Bert's got 3 stocks. There might be some dividend aristocrats on this list, some that have been beaten up over the last 12 to 15 months. I can't wait to see what Bert's watching here in 2023. A couple of different industries here, a lot of different players that Bert's looking at right now. And Bert, how many out of these 3 stocks do you currently own in your dividend stock portfolio?
We got 2 of them. I own the 2 highest yielding that we're going to feature today. So wow. Yeah, it's been great. So first, before we dive into each one of them, run them through our screener, let's tell you about our dividend stock screener. That seems like a pretty good idea, doesn't it? We screen, all stocks through the Dividend Diplomats dividend stock screener, which features 3 metrics and a bonus metric. 1, PE ratio less than the S&P 500. 2, payout ratio less than 60%. 3, history of increasing the dividends, where we look at the 5-year average dividend growth rate and how many years a company has increased its dividend. And that bonus metric is the dividend yield. We never lead with yield. We always make sure the company fits our other metrics first, and then we talk about the dividend yield, because that's one of our biggest investing lessons for beginning investors is do not chase dividend yield.
Don't go chasing dividends. All right, guys. Market is up this year, but these stocks have been down over the last 52 weeks, 1 or 2, even over 40%. Bert, what's that first stock that's hot on your stocks to buy in 2023?
TRO. It's T. Rowe Price, ticker symbol TROW. So T. Rowe's off to a hot start in 2023. They are up 2.88%, which sure as heck is better than the fact they were down 41% over the last 52 weeks. 2022 wasn't great. 2023 is starting off a little bit better, especially as the S&P 500 had that nice first week or so here in 2023. Look, T. Rowe Price is a dividend aristocrat. They were beaten down with the market, so they still continue to show signs of undervaluation, even though they had that nice pop on Friday, January 6th. They ended the week at 112.29, a slight increase from where they were in the low hundreds. And Lanny, I could not be more jealous that you snagged 1 share of T. Rowe before that price popped on Friday.
Just grabbed 1 share. And I mean, again, guys, keep in mind, T. Rowe was one of the largest asset management companies in the world. So just keep that in mind. They're one of the big players. There's BlackRock, there's Fidelity, there's Vanguard. There's also T. Rowe Price with a pretty good balance sheet, pretty nice payout ratio, as we'll find out, even though expected earnings are down. When the markets are down, earnings are down for T. Rowe Price. So Bert, down 41%, trading at $112.29. What's that price to earnings ratio look like for the big dividend aristocrat?
15.40 when you consider those forward earnings of $7.29. That payout ratio is looking pretty solid too, even with the slight decrease in earnings they're experiencing or expected to experience this year compared to the previous years. Payout ratio is 66%, so just a hair above our 60%, but not at the levels where we're concerned about a dividend cut.
Yeah, now dividend growth may not be as balmy as what it used to be back in the last 5 to 10 years, But again, one of the biggest players in the space right now. Obviously, they handle a lot more assets than what we even realize. But let's dive into that dividend growth
Yeah.
history, guys. At 36 plus years of juice in that dividend, longer than both Bert and I have been alive. And they've been growing that dividend at a rate of 16%, including a special dividend that was baked into there in 2021, if you guys remember that. So a very good dividend payer.
Mhm.
I own a ton of them. I think I have over 100 shares. Bert, you over 100 shares as well?
I don't know exactly how many I have, but I know I've also been building them in my wife's traditional too. So I can't remember my exact count. So I apologize, everybody. But for my wife, over the last like 6 months, we've been building her position to 14 shares at an average cost basis of 108.98. So that's what's kind of been cool about T Rowe.
Hey, yeah, that's a pretty good average cost basis right there. So again, solid PE ratio, a little high on the dividend payout ratio. We'll show the metrics of T Rowe here really quick.
Mhm.
Long-term history of growing dividends with an above average dividend yield at 4.2+% on this dividend stock over that you could approximate almost 3 times the S&P 500.
Yeah, and that's why they can, as long as the yield's over 4%, they're going to continue remaining very high on my watch list as a stock to buy and continuing to possibly add to my wife's portfolio every single Monday after the Johnson and Johnson goal was achieved of hitting 100 shares each.
Exactly. Now, Bert, that was just one stock. I know you've got 3. What's that second dividend stock that you're still looking at right here?
You're probably getting tired of hearing us talk about them. Intel, ticker symbol INTC. We know enough about them. They've had a rough 2022. Semiconductor was hit with a lot of supply chain issues, a lot of overall problems dragging down Intel, some slight revenue decreases. But again, they're still a cash cow. They're still earning a ton of money, which continues to pique my interest in Intel and want them on the watch list. I started buying them when they were in the 40s, which again seems like so long ago that we were buying Intel at those valuations, and we continued adding and nibbling to our position in Intel as the price dropped into the 30s, into the low 30s, into the high 20s, into the mid 20s. We've continued to just nibble and keep picking at Intel at these levels because overall, I'm longer on the semiconductor and the chip sector. Once they figure out these supply chain issues, they make the investments in the United States and North America to solve future supply chain issues as well. That's just my personal belief, everybody. However
Especially
you view this.
big investments in Ohio, baby.
I do love Ohio companies. I do love when people put the money into the Buckeye State. That's what it's about.
Hey, what else was I going to say was how are they performing right now in 2023 after that first week?
Up 7.48%, down 46.24% over 52 weeks. And that's still what's interesting. You know, they're performing well in 2023 so far. They are still yielding above 5%, which is where Intel continues to pique my interest. But of course, let's look at them in the other metrics here to make sure that the other metrics are looking great before we just see a 5% yield and run for the hills.
Right. So guys, to dive into that price to earnings ratio again, Intel is still trading at $28.73. Expected earnings only $1.88 right now. Obviously, a very conservative approach. The price to earnings ratio is a little bit lower than T Rowe's at 15.28. So reasonably valued right now for Intel.
Their annual dividends 146. Divide that by the 188. That gives you a payout ratio of 77%. So obviously, in the short term, the earnings are depressed. Longer term, earnings forecasts are a lot forward. So the payout ratio is a little higher than our 60%. So that's why I'm not immediately running and saying buy, but it's something to keep an eye on. Especially as I personally believe that the earnings are going to grow in the future once these supply chain issues get resolved.
Going into dividend growth, obviously they've continued to grow their dividend for almost 10 years at 8+. There was one little pause where they didn't grow their dividend. Bert knows I'm always frustrated about that. And it comes up every single time we talk about Intel. But, they've been growing it at 6%. Now, do I think they're going to be at 6% growth this year? Probably not. I would expect slow growth for 2 years at least.
Yeah, I would agree for that. And they've increased the dividend for 8 years, but I could also see some of the frustrating where it's like they increase it every 6 quarters or something. They might play around with it to keep the streak alive, but not immediately bump up the payout to shareholders. That could easily be a scenario that
keeping that Undertaker WrestleMania streak alive.
Yeah. So just to summarize here, PE ratio of 15.28, payout 77%, 5-year dividend growth rate 6.29%, increase the dividend for 8 years and a yield of 5%. And again, it's just the reason I kept saying this is what I believe, this is what I'm thinking for Intel. It's just one of those companies where people have different opinions about where Intel's going and where the chip sector is. I'm not telling you, I'm trying to give you why I'm liking Intel at this moment, because I think the sector is going to be great, but there are a lot of people that could just say, I don't like the sector, I'm avoiding Intel altogether. I think they're a loser, and that's okay. And that is okay, everybody. We don't all have to agree on every investment decision together. That's why you do your own research and come up with your own conclusions about these companies.
All right, let's dive into that third dividend stock here. Bert is featuring number 3. Remember to smash that subscribe button, guys. Give this video a thumbs up because we're diving back into a stock we just recently featured. Hit him, Bert.
Microsoft, ticker symbol MSFT. This was the latest video on our channel. This was the last video. We did a deep dive into Microsoft, the $1 trillion market cap darling that's yielding above 1.2% after they are down over 20% over the last 52 weeks and over 6% year to date in 2023.
Yeah, check that video out for another, again, for more metrics, more, look at the financial statements. But Bert, again, trading at just under $225 a share at $224.93. What are some of the reasons why this dividend growth stock, yes, Microsoft, a dividend growth stock, is on your watch list, your stocks to buy?
Yeah, the PE ratio is, after taking forward earnings to 955, PE ratio is 23.55, which is a little bit above the market, but well below where companies like Microsoft traditionally trade from a PE perspective. Their payout ratio is only 28% when you consider their $2.72 dividend. So very, very low.
That's super low compared to the other 2 stocks on this watch list. Again, they're a high profit margin business. Again, check the video. 35% profit margins, which means that earnings is just massive, and they need to keep acquiring and reinvesting to continue to grow that revenue. And Microsoft continues to do every single freaking year.
Yeah.
And that's not the best part about it, though, right?
No, it's not. Their 5-year dividend growth rate is 9.82%, and it's very consistent because their last dividend increase in September was right around this mark too. It was right around 9%. So very consistent, near double digit increase for shareholders, which is important because if you're only going to have a yield of 1.2%, you're going to have a very low yield. You better have a solid and strong dividend increase that goes along with it every year. And that puts the dividend factor that we always talk about, low yield. You take the yield plus the dividend growth rate. We always look for about 10%. Microsoft 1.2 plus 9.8. That exceeds the 10% threshold that we typically like to see.
Oh, it's true. It's damn freaking true, guys. And again, they're down 28% over the last 52 weeks, down over 6%. Right now in 2023, a lot of dividend investors and investors right now in this community, are buying and scooping up shares of Microsoft stock. So, Bert, I could see why it is on your dividend stock watch list.
That's right. So just to summarize here, the 3 companies, T. Rowe, Intel, Microsoft. We'll keep the chart up here for a little bit so you can see the metrics of all 3 side by side. What am I thinking here at these levels? I said, let's talk about Microsoft first. I said at the end of the last video, Lanny and I kind of talked about how Microsoft, and we'd like it a little bit more around like the 210, 215 range. So that's kind of what I'm thinking for Microsoft. There's a point, if it keeps falling, I might start scooping up Microsoft 1 share per week to replace Johnson & Johnson. We'll see, but it's close to the levels where I'm very strongly considering that. T. Rowe, I still love T. Rowe at this price and the yield of over 4% in the metrics. I think it's just one that I just want to keep doing and keep building my wife's position, particularly for T. Rowe. I'd love to get it 20 to 25 shares in the long run is like a short-term 2023 goal. And Intel, going to continue picking at Intel, especially if it's below 30. It's a very easy, let me just move $30 to my brokerage and grab 1 share of Intel at a yield of 5%. It's a very quick one. I'm not going to dump in thousands of dollars right now, but I'll just keep picking and lowering that cost basis for Intel.
Guys, what dividend stocks out of Bert's 3 are you watching? Do you think any of these 3 are stocks to buy right now? Again, don't forget to subscribe to the channel and like the video. Bert, what else do you got for the community right here, right now?
Let's just crush it in 2023, everybody. Let's stop messing around. Let's keep growing our dividend income, keep growing our passive income so we can all reach financial freedom. And Lanny, What's our outro tagline here?
Guys, you're either with us or you're against us. That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.